What's more broadly on the session today?
James, look, we certainly started off this morning very positively from those leads coming from Wall Street and, of course, Europe. We saw that consumer sentiment over in the US reaching an 11-month high, and, of course, further expectations coming out of that ECB meeting on Thursday certainly helped overseas markets, and we saw our markets starting very strongly. But as Mike has mentioned, we certainly did lose a lot of that positive momentum. Obviously, we saw that risk-off sentiment on markets last week. So certainly positive that we have closed up about 0.2% in the end, but a bit disappointing losing some of that momentum. Obviously, the worst performers, we did see a bit of a turnaround in the banking sector. Telstra was down about 0.8%, and we also saw the supermarkets coming under pressure. So the telco sector as well as the staples sector were the two worst performers. The best performers, as Mike has mentioned, was the materials space and, of course, the energy sector. We saw a bounce in those commodity prices. We did see some of those copper and gold miners actually leading the way, so the likes of Oz Minerals, Sandfire, and, of course, Panost as well. And also in that energy space, we saw Sundance absolutely surging today, up about 12%. But on the other end of the spectrum, we saw Paladin Energy coming under a bit of pressure after coming through with a guidance downgrade. So, look, overall, I think it was a bit disappointing seeing that turnaround, but nice that we have actually started the week in positive territory.
One of the other dominant sectors, the banks, the oft-quoted Charlie Aitken again quoted today, talking about reversing their preference for the banks. In particular, I think it was NAB and ANZ. I mean, is it an area that you think holds opportunities?
James, I do think the banking space does hold opportunities. Our view, I think, over the next 12 months or so is that we might see a bit of a neutral performance out of the banks in terms of that share, capital growth coming out of the share prices. Obviously, the banks, as we know, have been trading at very high levels, so there has been a bit of concern that we are expecting to see a bit of a pullback in some of those share prices. But I certainly think for a lot of our client base, we still very much like the space in terms of being high yielding. I think this year one of the big focus points is still going to remain those high yielding stocks as it was over 2014, and I think in particular, given that volatility is expected to continue and, of course, low interest rates as well, I think those high yielding sectors will certainly remain in favour. So my view is that banking space certainly does still remain very favourable, particularly to a lot of those self-managed super funds and those investors looking for high yield. I'm not too sure if we'll get the sort of increases in those share prices that we have seen, but certainly think they do remain in focus, particularly in terms of their yields.
More broadly on the financials, Macquarie, Leanne, we were talking about it earlier, bumper session off the back of a profit upgrade.
It was. It had an absolute stellar session today, up about 5.4% in the end, James, upgrading their full-year FY15 outlook by about 10 to 20% or so. Certainly saw investors reacting very well to that news. As we spoke about earlier, that full-year profit last year was up 49%. So if we can see that increase, I think that will be exceptionally pleasing. Obviously, we will know more out at that operational briefing coming through in February. I think in the short term, some of the impacts still do remain in terms of those foreign exchange movements, although we do know that they have said that lower Aussie dollar is certainly having a positive impact, but also in terms of some of those regulatory changes coming out of that financial inquiry report. So sort of a few things to focus on in the short term, but certainly longer term, we do remain very optimistic in terms of this stock. They have a very strong capital position to maintain that dividend payout ratio, obviously leverage to North America, Asia, and, of course, looking across Europe as well, but particularly coming out of the US, where about a third of their operating incomes are sourced. So expecting those revenues to continue. And, of course, looking at pushing into that net interest income space. We do think that is going to, given the fact that we're likely to see these rises in these interest rates, that is certainly going to help out in terms of their annuity-style contributions. So Bell Potter actually believes that they should be trading at a premium to some of their US-based peers where they're not at the moment. So potentially do believe that there is a bit more upside in that share price to come, and obviously off the back of this result or this news that's come through today, I think suggesting that we may in fact see that.